The last of the curtain raisers for the quarterly GDP came out today. It's the current account, that is exports and imports and money moving in and out of the country. It was the second current account deficit in a row and the biggest in 6 years. So net exports will be a bit of a drag on June quarter GDP. The nation's economic forecasters keyed the latest numbers into their spreadsheets today to see what the Excel god would give them for tomorrow. And the answer on average is 0.2% growth for the quarter, 0.9% for the year. So we'll see how they go tomorrow. With population growth of 0.65% for the 3 months, that means per capita GDP is another big negative for the 6th consecutive quarter. And that's 3 recessions on the trot, per person that is. Without population growth, it would be 1991 and 1982 rolled into one. Here's a chart of annual GDP growth since 1961. 0.9% will be well below the average of 3.4% growth per year and would fit with the long-term downtrend. Ever since the Reserve Bank got independence and started targeting 2 to 3% inflation, we haven't had any recessions, apart from COVID. Although, as discussed, the past 18 months would have been all recession without a boom in migration. The Aussie dollar drifted lower today in anticipation of weak GDP tomorrow. The share market also drifted lower with banks up, miners down and Coles and Woolies both paying dividends. Here's why the miners fell today. Iron ore dropped 4% and Wall Street was closed for Labor Day, so Asian markets were rudderless. And that's finance.